Hello, I'm Nick Bullick, a director within the investment team at Qualitas and portfolio manager for QRI, and I'm pleased to present the June 2021 quarterly review. During the June quarter, the origination of new opportunities continued to be strong and is well diversified across property sectors, reflective of growing CRE debt market, both in demand and supply of credit. Whilst the alternate lender competition continues to increase and we're starting to see loan pricing compress, we firmly remain focused on ensuring we achieve the best risk-adjusted returns for the trust and a continued emphasis on borrower quality. In addition to the 54 mil placement closed on the 1st of April, we raised a further 12.7 mil of new capital from existing unit holders through a unit purchase plan, which closed on the 29th of June. And we would like to take the opportunity to thank our existing unit holders for continuing to support QRI. Investment activity during the quarter was strong, and we closed 8 new loans worth 189 million, which were funded via the capital raise, as well as $98 million worth of repayments. We elected to fully redeem and exit a $26.5 million investment in the Arch Finance notes as to align with our strategy to increase the trust's exposure to direct loan investments. The key benefit of direct loans is greater flexibility to manage the trust portfolio composition whilst providing greater control over loan assets. Exposure to direct investments has now increased to 86% of the invested portfolio. The trust's investment objectives of target return, portfolio diversification, and capital preservation were all met during the quarter. We continued to deliver consistent returns in a well-diversified loan portfolio that is predominantly senior first mortgage. The distribution return for the quarter and the financial year was 6.14% per annum and 6.15% per annum respectively. We maintain our loan reviews monthly, and we're pleased to report that the loan portfolio is performing with no impairments recorded or interest arrears, resulting in a stable net asset value. We will now look at a more in-depth update on the market outlook and fund performance for the June quarter. Despite the macroeconomic backdrop of COVID-19 continuing to impact various parts of the country, Australia has generally demonstrated a level of economic resilience as supported by the government. We expect to be in a low interest rate environment for some time, which will continue to support positive asset yields. We are seeing no major distress in the CRE debt market, and generally those conditions in Australia are more favourable than offshore markets, which has led to increased investment activity from both domestic and offshore alternative lenders in recent months. Our sector outlook has not changed as the same risks remain present, and we're comfortable navigating the diverse sector opportunities presented in the market. We are, however, seeing more pre-development land loan opportunities as developers secure sites in readiness for the next development cycle. We expect residual stock loan opportunities to reduce over the next 12 months in line with reducing completed apartments across the market. We are closely watching the market more generally in light of recent lockdowns in Sydney and Melbourne, and confirm there is only 10% portfolio exposure to construction loans for projects still under construction, which are all located in Melbourne, where construction sites have not closed. The manager is comfortable that each construction loan has adequate contingencies and equity to cover extended delays from the risk of lockdown should this occur in Melbourne as well. As mentioned before, our pipeline is strong at 475 million and is well diversified across all property sectors. Loan pricing has started to compress due to increased competition. However, we remain disciplined with our investment selection and will not compromise on transactions which present material credit risks, ensuring strong sponsor and property quality. QRI's trading performance remained consistent during the quarter and pleasingly continued to trade at a slight premium to its net asset value of $1.60. We have demonstrated over the past 12 months that we're able to support the unit price during times of volatility, and will be actively monitoring markets in light of the ongoing COVID-19 risks. The Trust's investment mandate constraints and manager key targets were all met. The significant change to focus on is that we're no longer holding Arch Finance notes, given its redemption and full exit in June, which further reduced our exposure to indirect loans. We've been transitioning the portfolio to more direct loan exposure, and since June last year, direct loans increased from 45% to 86% of the invested portfolio. We've achieved this by investing available capital into direct loans and electing to reduce indirect loan investments by part redemption of the Qualitas Senior Debt Fund units and full redemption and exit of the Arch Finance notes. We also expect to fully exit the Qualitas Land Debt Fund in September once the final loan repays. The key benefit of direct loans is the greater flexibility to manage the trust's portfolio composition whilst providing greater control over loan assets. On this slide, we demonstrate the portfolio composition as of 30 June 2021, with no material changes other than the redemption and full exit of the 26.5 million Arch Finance notes. Please note that the 12.7 mil of new capital raised from the unit purchase plan settled on the 6th of July and is not reflective here. The trust is 86% deployed and the remaining cash is fully allocated to new investments expected to close in the upcoming months. We do note that there is a high concentration of loans in the residential sector and located in Melbourne. However, a large proportion of these are residual stock investment loans, which are expected to naturally amortise over the next 6 to 12 months. We also note that the weighted average LVR has increased from 61% to 64%, which is largely due to an increase in residual stock loans, which we feel is acceptable risk at this point in the cycle. In summary, QRI continues to perform and meet its investment objectives despite a macroeconomic backdrop of COVID-19 continuing into the foreseeable future. The alternative lending market continues to grow and QRI is well positioned due to its long-term market presence and deep borrower relationships. Investors have continued to support QRI given it seeks to offer attractive risk-adjusted returns in a low interest rate environment. As a leading investment manager in CRE debt, we are committed to educating our investors on this specialised asset class. Thank you.